Okay, testing, making sure my audio sounds good. It's a reason. Okay, now the connection's going through. Looks good. All right, David, are you feeling like you're ready to go?
I'm ready to go.
Excellent. Right. Ladies and gentlemen, welcome back to another show with TradingView and TradeStation. This is the TradingView show, and it is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, and futures markets. Now, it's quite important for me to say that David is the man behind the TradeStation account on TradingView. So this is one of my favorite parts about the show, is that you are quite literally meeting the person who is providing to you all of that information, research, and deep dives into various charts. And now you get a chance to hear from him directly about what's going to be going on in the upcoming month and what you should be looking at. And David, before I say any more, because I know we've got a lot planned on this month's chat, let you take it away.
All right. Well, it's good to be back with everyone. Nice to see you again, Steph. Actually, Steph, I want to start off. Well, first, I'm showing the standardized returns of some ETFs. I'm just doing this on TradeStation just because if we talk about ETFs, I want to make sure you guys are able to see those. Now, Steph, I want to ask you a question actually to start. If we went back to this weekend or last week and I said, what geopolitical events are going to move the market next week? Most people probably, what would you have said?
What geopolitical events? I would guess the election.
Okay. I was thinking, strife in the Middle East. Everyone was worried about Lebanon, all that. So people worry, oh my God, there's going to be violence and escalation. Instead, what geopolitical events did we get? We got China double dose stimulating the money and then fiscal stimulus coming. So we had a double dose of bullish news from China. And then instead of there being escalation and trouble in the Middle East, we have the Saudis increasing oil production and crushing oil and setting us on a spot for more sort of lower inflation and the potential for lower interest rates. So I want to point that out that in a bull market, this is what happens. Things that should be bearish suddenly turn into bullish, and the same thing happens in the opposite in a bearish market. But it's important, I think, to realize that nobody, I think, expected the kind of news that we got, and I'm not even sure how much attention the oil news got. But it's a story from Reuters, and basically oil's getting crushed, and all those things fit together being positive for interest rates. So I just want to point that out. To me, it really kind of confirms the environment we're in. I've seen commentary about all the cash on the sidelines. Tom Lee, big kind of strategist who's on CNBC a lot, he was saying that family offices don't want to buy before the election. They think we're in a recession. They don't have money. They don't have margin debt in place. So you basically have an economy or you have a market that is under leveraged to the upside. There's a lot of cash on the sideline. And again, what do we see? We simply see that there's just money coming off the sidelines and there's no, sellers get punished in this market. Market goes down a little and immediately money comes off the sidelines to support it.
Well, I have to say that is fantastic because you're exactly right. I thought I would have said elections, and now you're speaking about what the Chinese economy is doing and an increased supply in oil, which, correct me here if I'm wrong or not, or if this is the way to think about it, essentially higher production of oil leads to more oil, which leads to lower gas costs, which means consumers save money every week and month, basically, on filling up their tank. Is that the way to think about it?
Yep. It also means more rate cuts, or at least leans in that direction. So I think
Can you explain that
it,
for the viewers? That's interesting.
well, I mean, lower oil if oil goes down and stays down, it's a huge part of inflation. I personally believe that a lot of the talk about services inflation, I think a lot of that really does just follow energy prices, transportation services, all those things. When oil goes up, they start raising different fees and things like that. You see the same thing with things like airfare. Now the opposite is happening as oil goes down. Basically, that creates a downward pressure on a lot of the inflation, across the whole complex. So I think that's basically the long and short of it. And there are some other kickers. You want to talk about mortgage rates? I want to get to that too, because I think that's another part of the argument, is that basically, because something is going to happen with rate cuts. That has another impact, I think, on inflation that is not as much appreciated. But the key thing is that you have lots of oil, and there's going to be more. All the OPEC plus countries now are increasing. Well, I'm not sure all of them are increasing production, but essentially, it's kind of every man for himself. OPEC came together during COVID, and they've just been crumbling apart ever since. And I think that's that was just an unexpected thing this morning.
And how about the aspect of what the Chinese economy is up to? Well, because speaking of this morning, as we were just talking, I was watching the hedge fund manager, David Tepper, and he was speaking of Chinese stocks. And you and I were just chatting before we went live, and you actually gave me a very nice sort of background on, hey, you're not one to rush in such, quick commentary on TV. Maybe you could just remind people about that lesson as well, or what's going on in China in general.
It's been, there's two things happening. First, you have a macroeconomic situation that's bad because they have, relatively weak demand, and they have this problem with their housing market. They have bad demographics. They are overly reliant on exports. We're such a large country, they're incredibly reliant on exports. So that's a problem. So you have this relief rally in China based on the fact that people were so negative on it. Then you also have the regulatory side of it, which is that the government if you look at Chinese stocks here, this is the FXI, starting back here in 2021, Xi started cracking down on Chinese stocks and doing all kinds of kind of strict, kind of anti-business things that really hammered it. And now they're coming out and saying, we're going to do everything we can to support it. Now, we actually had some of this news back here. If you look back in April, May, there were a bunch of headlines on this. And then no, I'm sorry. This is the wrong, it was back here. We did get some clues about this back in April and May, and we wrote about it at the time, talked about it a little bit. But now we're getting to kind of follow through. So you have the combination of the American, with the Fed cutting rates, it also makes global stocks more attractive, things like Asia. So you have a lot of things happening, a combination of the stimulus side, which, when there's more money, people want to buy assets. But also when there's stimulus, it actually means that the economy in China maybe is a little bit better than people feared, which then also gives an overall boost to their stock. So it's a double whammy of that. I do think, though, you're in a spot here where I personally don't know how to approach this right now. When you have the FXI jumping, you can see levels like this, and I'm not even sure exactly how to assess something like this, at this moment in time. I'll be honest, I have not looked at Chinese stocks very much for the last year or two. I haven't really thought about all the different factors at work. And I feel that, it's one of these things when you need to be following things and have a good sense of them. Moves like this are great when you catch them. I would say, though, that as a trader, you cannot make a career out of catching things like this. And I think that, this is not really a trend. This is just one of these crazy reversals that we might have had some signs of it. And maybe there's times people can catch things like this, but this is one of those things that I think, to be realistic about trading, it's difficult to really think you're going to catch a lot of things like this overall. They are just they're crazy events that are pretty hard to anticipate or in any way kind of put a model around.
Yes, and it was not a specific asset class even that I was watching, but it does seem to open up the maybe bull market case a little bit. I don't know how you feel about that, because I know you have some charts planned for us around the equity markets as well, and I'm curious if
I gotta look at the S&P here, because there's a few things that were, to me, important. I have a few different charts to look at. First, so I want to look at the S&P here in terms of the 9-day rate of change. I've looked a lot at how when the 9-day rate of change goes negative and it starts kind of weakening, it gets a flush down. And then you can see when it kind of stabilizes, like we saw here, you get the continuation higher. The pullback we had over the summer was kind of very similar. The 9-day rate of change went negative. It stayed negative. We got that big flush down. And then you can see basically we came up and basically started trending higher again. And then basically the 9-day rate of change simply remained positive back here after October, pretty much all the way through like April. So it's interesting now is we're in another spot here where it, basically has turned positive again. We have this period of consolidation. Now, we've done this pattern. I wanted to mark it here, actually. I've talked about this a lot, and I don't even know what to call it. I just call it tight consolidation. I mean, it's nothing glamorous. It's not something that's gonna like get you maybe a lot of clicks if you like put up, fun charts and stuff. But I think it's a very valid pattern, and that is essentially that the market doesn't have sellers. It rallies in a tight pattern and continues. And we've seen this pattern at different times, like here and here, where it gets very tight and then it extends without a lot of selling. And in my view, that's when I saw this happening above the old high, it was to me a real signal. Also, RSI, we've talked about when it goes, when we call it kind of cooking. Well, it's interesting here, it's RSI here, is that it's kind of up in the mid 60s. And essentially when it's in these uptrends, it kind of just goes up between 60 to 75, and it's not anything dramatic. It just kind of sits up there and then it extends. And all these patterns look very similar to me to what we had seen before, a period of consolidation and then an acceleration. And new quarter underway. The other thing is, remember, September is supposed to be a bearish month. The period of time last 2 months before an election is supposed to be bearish. It has been. If you go back pretty much every election, um, last several elections, this chunk of time has been bearish. And I think a lot of people are in cash because of that, and they don't want to be taking risk. And in my view, that has the real risk of creating a runaway actually to the upside, of people being forced to chase, who are like, oh, of course the market's going to pull back. But here we are, 6 days above the old high, no pullback, rate of change positive. And it's like, what happens next? Does it just suddenly crash the way everyone wants when the Saudis are increasing oil production? The situation in the Middle East is not escalating. The Chinese are printing money. Jobless claims are coming down. Earnings season is coming. Does it suddenly crash? I mean, that's the problem. And then it's like, uh-oh, what happens now? And I think that's actually the sort of situation we're in. So that's the first thing on this chart. On this chart, I call this sector-based breadth or something. I don't know what to call it. I call it basically sector analysis. And I have come to increasingly be frustrated with breadth as a concept, advanced decline line, stocks making new highs and lows. I've actually found that in the last several years, it has been a contrary indicator. Good breadth means that utility stocks are going up and consumer staples are going up and healthcare and all these random stocks that nobody really cares about. Wow, they're making new 52-week highs. Well, that's really not what moves the market. So what's interesting is that when the mega caps outperform, the market has been going higher. So what this shows is, this shows the S&P 500 with a relative strength. The indicator in the bottom is basically XLC plus XLY plus XLK, which is PEC, communications, and consumer discretionaries. Those are the three mega cap sectors. And what we see when we look at this is that we see that when the S&P is lagging the mega caps, it rallies. So what this tells us, and this is the only way I could quickly chart it. You could probably flip this around and do some other creative coding. But the key thing is that this shows when this is negative, it actually means the mega caps are outperforming. And it shows that they drag the market higher. Then when the S&P outperforms the mega caps, you get weakness. You can see here, as the outperformance of the S&P over the mega caps happens, you get pullbacks. This has been the case at least since 2021 when interest rates started moving higher. So I want to point this out. What does this tell us? This tells us in the last 2 to 3 weeks, the NASDAQ has been coming back. The mega caps have been coming back. And we've done ideas on this on TradingView about the chips and Nvidia, and they more or less kind of confirm that bias. So we got to a point when you have to take a step back and say, what is the longer term trend here? The longer term trend has been the mega cap growth stocks. It has been things like Nvidia. It has been AI. We get the news from something like Micron last night, and surprise, surprise, AI is stronger than we thought. And then all those things come together, and then the NASDAQ, suddenly people come back to it. And I think that, for trend following purposes, this is telling us that whatever China does and all this other stuff that happens, ultimately at this point, we still have this dominant trend of mega cap growth.
David, I have to say, as always, it's a masterclass when we chat. Even going back to the chart you had up of the S&P 500, and with the RSI cooking, because I was taking mental notes of a lot of what you said. And first of all, to the 200 plus people who have already hopped on and are watching, Hey, thanks. We hope you're enjoying the show. We've been doing this for a while, and this is why I want to bring up RSI cooking. I like that we've got some technical themes throughout our period of running these shows, and the RSI cooking has come up a few times. And just for all the new people hopping in to catch them up to speed about this concept that you talk about, could you explain RSI cooking and using this indicator to look for this sort of cooking phase to everyone watching?
Yeah, the idea is that in a bull market, when things are trending higher, you will often see RSI. I'm going to actually make it more clear here. You will see RSI basically. All right, RSI will go overbought and stay overbought. Overbought on a short-term chart could actually tell you don't to sell, you know. But the thing is that when you're looking at things over on a daily chart, in my opinion, especially the S&P 500, when it tends to, or an index, when it goes overbought, that's a sign that it's bullish. And then tight pullbacks are buying opportunities. And so I think it was interesting, and I actually learned this by looking at 1995 on the S&P. I don't know if I can easily jump back that. I don't want to jump back that far. But if you look back at 1995, when we had a soft landing and the Fed cut interest rates, very similar environment to this. If you go back to that time, RSI basically went up and it just stayed between 60 and 75 for like 12 months, and the S&P barely pulled back. And that was the beginning of the phenomenal tech run. And so I think what's interesting now is that we've seen a very similar setup now. And when it goes up to that overbought condition, it tends to be followed by more strength. So that's my main point here is that when things are in uptrends, the RSI can actually help you see that it's in an uptrend.
So I really like that aspect too of the RSI cooking. And I just want to comment on it quick before I get to the ratio chart you had or the comparative chart, which is I feel like a lot of people when they see RSI, they think that overbought instantly means like things are, euphoric. There's too much buying. It needs to regress to the mean. But actually, based on this concept, which you've explained now in a few of our shows, I hope people are catching on to it because it's very interesting when it's cooking up there near the highs and just sort of staying up there, it's sitting in the burner's on high, it actually shows momentum and strength.
Yeah.
So I just think it's a really interesting takeaway. And ideally, a lot of people who, have never used RSI or maybe were taught an incorrect way, like that's a very interesting way to think about it. It's a sign of momentum, not necessarily it's, overbought or any sort. And
I
before,
would
yeah,
add very briefly that the one time here, if you look back in the summer of 2022, it was a bearish signal, but we were under the 200-day moving average. See, so you had a falling 200-day moving average, and in that case, we did have a downtrend. So when you have it can work, as a contrary signal when the action you're taking is consistent with the longer term trend. So in this case, we're in a bearish trend. If it went to overbought, then it actually is a sell signal. But if you're in a time when you have evidence of a longer term uptrend, then it does not constitute a sell signal. I always like to combine short term condition with longer term trend. And I so
and that's a nice demonstration of using two indicators to get a feel for direction and maybe for sentiment. So that's and I would say even though it hit those highs there, but it didn't cook. It just went right back. It went right back down too. So
exactly.
yeah. Well, and David, before we get to your other charts, how about the chart we were just looking at? You had the comparative analysis going on. Yes, excellent. So, is this a chart that you are? So, this is essentially a chart that you're watching to gauge whether the market is strong, it's bullish, it's risk on, because the large cap stocks are outperforming these specific sectors, right? That's the way to think about it.
Yeah. Essentially, well, to assess the actual leadership, you know,
Leadership, yeah.
is to show us where the leadership is. And the problem with breadth is that it's probably coincidental with traditional advanced decline line stuff that essentially shows us the wrong thing. It doesn't actually show us when the leaders are leading. It often shows us when the non-leaders are leading, and that's not necessarily bullish. So in this case, it allows us to focus in on the leaders.
Very interesting. Very interesting. And How about now moving on from the S&P 500? I know that you had a few other charts to show us, especially I think about the
I,
NASDAQ as well.
yeah, I wanted to
Curious,
show you this.
yeah.
So I was doing a little analysis, and what I found is that when the NASDAQ is above its 200-day moving average, the 20 and 50 crossover has been a pretty interesting signal. When it crosses over, I mean, it's often, you know, um, it often happens when the market's already somewhat overbought, but it's been an interesting signal, kind of like since down here. But I think it's interesting I mean, these are patterns that are not necessarily just like they're good signals, but they're not necessarily meaning like you just mindlessly follow them, because sometimes it occurs in an overbought condition. But the key thing here is that it is an overall setup that is consistent with an uptrend. So what do we have? We have basically this intermediate term trend line that we broke, and we have the cross of the 20 above the 50. So, this is, I think, kind of telling us here that all this period of angst and sideways is over. It's also interesting to take a look and realize that we broke above that high from the previous month. So it's kind of like Bitcoin. It happened a little bit before Bitcoin, but essentially we have a higher high, we have a higher low, and we have a higher high. And so it tells you that this period is now finished. And then when you have the 20 cross above the 50, it also kind of shows us that it seems to be over. So
So would you say that the S&P 500 is actually the chart of the S&P 500 and its trend looks a little smoother and almost more organized than the Nasdaq 100? The Nasdaq 100 looks surprisingly messy to me. Like it has a bigger hill to climb. I mean, right? Is that what you're seeing as well?
well, I think that is true to a certain extent, but I think the way this market is, I mean, if you believe in long-term momentum investing, which I kind of think is an interesting way to approach things, the Jim O'Neill kind of view of these mega growth stocks that are really in secular growth phases, then something like this is not really a problem. This tends to make moves when you look at it historically, that it just accelerates and that's it. So I wouldn't overthink that. I mean, from my perspective, I would say if anything, this has more potential to accelerate versus the S&P, which which will benefit from the Nasdaq accelerating. But I wouldn't view it as simply of is it making new highs or not. Simply because there's different things. I mean, when things come off lows, like the way the Chinese stocks did, they can have these explosive moves. And when something has been stuck and it's kind of sitting and waiting and not doing anything and people suddenly rush into it, that actually can be the spot that gives more return and more actual opportunity with less risk. So from my view, when this essentially crossed that trend line, and we've been looking at the stocks. If you look at some of our ideas on TradingView, we basically looked at when the stocks came off the 200-day, and we were basically kind of saying like historically, if you really take a step back, that was the first rally off of the 200-day. You basically had this pullback back here, and then this was back last fall, and then you had it crossed back when the AI boom kind of started. Wait, was I doing it on? I was doing it on Nvidia. I'm
You
trying to
know
remember
what?
which stock there's a trading view idea I did that looked at the 200-day moving average on one of the semiconductors.
I have to say on this note, by the way, because we were speaking about Nvidia as well before the show, and and it kind of it ties into this Nasdaq 100, S&P 500 move, and essentially what I'm curious to hear because I think you had said that you could see Nvidia going back to its highs, right? And I'd love to dive into that a little bit more because
Yeah.
the market's just fascinating. Every time you think like a trend is over, it's gone too high, it can't go any higher. The market just continually surprises people. It goes higher. It's just like strength begets more strength. You telling me that maybe Nvidia's got this potential, really my ears perked up. So I'd be so interested to hear your analysis of Nvidia at this point in time,
So
especially
this
because
was
of
the
its
actual.
weighting.
Yeah, well, I mean, I would actually, I know we talk about charts here, but I'd encourage guys to go and listen to Jensen Huang's presentation at that Goldman Sachs conference a week or two ago. It's on the investor relations page. Yeah, I never really appreciated. I mean, this guy makes Steve Jobs look like nobody. if you really think about it,
Wow.
what he's done. I mean, he has created this entire ecosystem of software connected to his hardware that is, it makes it so, I don't want to say addictive, but it is so, the moats around it. These are products that there's a large set of important people using these products who are reliant on them, and their market is pretty well set into the future. So, what we looked at in this chart was just the fact that it had this line. It was a very tight pattern. It had an inside week, and that, so you have all this swinging up and down. This is the trading view idea we did. You can see it moved off of this zone. But what was important to me about this is you had all this volatility and then it squeezes. And if you look at other times, it did similar things like this. And we actually had another idea. If you look back, when I think if you it's this idea, I think we referenced it here at the bottom. No, there was something where basically, if you look at the way Nvidia had traded before, the period. I'm going to go back and see if I can. If you actually look on the chart, the amount of time between look bullish, the bearish outside reversal day. Look at this, and the amount of time, it was like 29 bars. Now look at this, copy, and then go to this one. 29 bars as well. I'm gonna drag it over. So we want it to be basically lined up. Where basically we want that it's starting at that candle. Essentially, look at how it bottomed. 29 bars. Like,
Wow.
boom. Like, to the I mean, I have to exactly finagle this over. But you'll see, essentially, if you go from that bearish outside reversal day, so this is the way Nvidia trades. It basically rallies, it gets frothy, and it blows out, and then it kind of staggers, and then it crashes. Same thing, and then it comes together, and then it repeats. And so here what we have? We have this kind of, come see how it comes together. It got frothy, it comes together, and then it accelerates. Gets frothy, gets staggers down, crashes. Now it's coming together. That's what the inside week told us. The inside week was the pattern that set me off to this. The other thing was the fact that I had been watching 117 on this chart for a long time because it had been support at different times, and I did some kind of story or idea. It might have been this one. I've done so many. I'm trying to actually remember them, but it was this one here. No, it wasn't this one. We did one. If you look back to this date on TradingView, I'm sorry, I'm all over the place. All right, when it broke down through in around July 24th, and we basically said at this point in time, chips are in trouble for a while, and we basically compared them at that time. I think you and I talked about it, how the banks were coming back against the chips. We did an idea showing how the banks were outperforming against the chips, and that was the rotation. That was the beginning of this. So we look back this period in July, right there. This, you can see, as the mega caps were losing favor against the S&P right at this time around July 20th. You can see that the S&P started outperforming the mega caps right at that time. And then you look on this chart, you can basically see right around that same time, around July 20th, look what happens. Boom. So basically, that's what you see what I mean? These things tie together. You could see the strength shifting away from the mega caps toward banks, toward the Russell, toward utilities and REITs and all the other little $2 billion companies. It was shifting toward all those other little companies, and then the money came out of the mega caps, and then we entered this period of volatility. But now that is fading, and now what are we coming? Now it comes together. The inside week tells us we break above the line, and now we see the continuation. So to me, that's kind of how I view it. And so when I started seeing this in Nvidia, when I saw also, it was very interesting to me what happened in Meta, where basically Meta, look at how when the market crashed, Meta did not even make a
Jeez.
new low versus 2 weeks before. And then you can see how it just, I mean, I looked at this in Meta in different times when it basically, it was so tight, and then it basically just broke out. And a lot of these things also were kind of, were telling me that the large caps had kind of come back. So to me, it was the big point was that we had our period of volatility and consolidation, and the longer term trend remains in effect.
I have to say, on the Nvidia chart, I really like the process of the bar counting you're doing or the day counting. And, we've heard it before about, history may not repeat, but it rhymes. So there's a really nice aspect there of actually looking back at what happened, utilizing that information, down to a science, like it's the exact same number of bars or days, and to see if that's actually taking
Close.
place in markets. So it's
Yeah.
quite interesting. And I'll say this, the candle that's happening today too, there's that green filled in candle, very also interesting as well that it's holding this. And actually, interesting enough, similar to Bitcoin, it's in the process of trying to end that lower low since it's
Yeah.
high. And if it can just keep going, it's going to invalidate that. So I think that is a great chart. And as we know, it's the third largest company in the market right now by market cap. I believe it's back to 3 trillion, but it has fallen back behind Apple, Microsoft, but still that's a huge weighting in the market. And by the way, your Meta chart, how did we all miss the simple fact that Meta is like one of the greatest AI plays you can make? You right? I mean, they have everyone's data. They're just going to feed that into a machine learning. Their models are going to be so advanced because they have ingested so much data. And is that an all-time high that it's at right now after
Yeah.
their Ray-Ban glasses announcement?
Well, it was before when people knew
Before.
about it. But again, what do we have? 50%. There we go. Held the 50% and just quietly snuck higher. And this is, I think this is just a sort of thing that I was looking at this and it was like sometimes I look at things, I'm like, why it's not doing anything? Why am I wanted to do, but then you realize in some ways not doing something when you're near an all-time high is actually important because it means you're not falling and that means people are not selling. And that was a sign of things getting ready. But when we held the 50% retracement, that was very interesting here as well. This to me was a real signal here, and something like Meta at this point in time. Their earnings are, out here. So I think this is one where I think people might want to be kind of wondering if it does not maybe just melt higher toward the earnings report, just potentially.
Yeah, it's also just equally interesting that now they really are. I thought Zuck would have given up on his hardware push because it didn't seem like the Oculus really took off. And so I thought, hey, he spent a lot of money. He's probably going to slow down, but he's fearless. He's still pressing the gas pretty heavily on hardware. Now he's making the AR VR glasses. It's just a very interesting moment for. Maybe they just have the cash flow and they already have the social network and they have the AI models to where they can still take the risk in hardware and try to maybe upseat Apple if they can actually
And
pull it off.
they were early before. Before, when they tried to do it, people were worried about costs. That was a time when people were hiring left and right and investors were annoyed at it. Interest rates were moving higher. People are not going to be tolerant of what Meta was doing in 2022. But this is a different world, and Nvidia has already proven that AI is real. And now it's easier for someone like Zuckerberg to do that. So I think and another thing is just the context. AI was not a narrative when he tried it before. He might have just been early.
That's so interesting how, I mean, of course, timing is essential, but just how the narrative can influence the luck of your time. Because you're exactly right. The AI story has really given him like supporting narrative he needs to push into it. And hey, now interest rates are being cut. I mean, I'm curious. Do you have some charts on interest rates or anything you're watching? I know in our last show that was a big topic. We started off with it. Yeah. Let's see TNX and what you got here.
I mean, to me, it's interesting. This little downtrend is forming, um, and in my view, this is now a spot where people are probably just looking for this to have just a kind of gravitational pull down to 3.25. I'm not sure exactly. I think in many ways, though, a lot of this has now happened, and I'm not sure really what to make of it, how much real opportunity there is in this. I tend to think that we're now in an environment, we've talked about how there's kind of like a volatility cycle and things are really correlated and things are not. But we're in a period now when I think a lot of the big moves and some of these big things have kind of happened. And so I think right now it's interesting to see interest rates back up to this level. However, when you see the kind of risk appetite we're seeing and things like that, it also is not necessarily consistent with the 10-year just going straight down. The economic data continues to surprise to the upside today. Jobless claims better than expected. Some of the industrial data was very positive recently, and I believe we're going to see something with housing, which you want to talk about. But we are starting to see activity in housing, and those things are going to. There's a good chance we're going to see GDP actually accelerate from here, as more houses getting built, holiday season, all those sort of things happening. That the impact of lower interest rates, business sentiment, small business sentiment was starting to get better recently. I think we're at a spot here where we can see the economy improving. So I think interest rates here. I think that the easy to anticipate and chart moves have essentially happened. I think we do have a little bit of a trend here, but we have payrolls next Friday. So in my view, there might be a little bit more kind of upward drift and just kind of floating around. I don't see any clear edge here. The bias is to the downside. I think that's pretty probable. But the in terms of anything near term, I think it's pretty sloppy.
So I have one thing to say for our viewers and then a question for you. The first aspect I want to say to our viewers is that beautiful chart right there that you're looking at, David and I have marked up on our last several shows. So if you want to watch this all happen in real time, go back to our last show, find the interest rates part, watch it. Go back to the show before that, look for the interest rates aspect, then watch it. And it's pretty neat to see how well actually it's followed these technical drawings. Like that weekly downtrend was drawn, I think 2 or 3 months ago. Look at the weekly uptrend then break through. We have the June 2008 high there, which is a huge level. It went underneath that, and that was it from there. Couldn't reclaim it. So I just have to make that comment because I think that's this chart is wonderful to me. In fact, yes, if you're watching today's show and enjoying it, go find our previous chats on this. And then the other aspect is when you zoom out, I love, I always look for those lows on these time frames. Now, where you start that weekly uptrend at it looks like 2, yeah.
2.5.
What do you think? Do you think we're going back, or it's just not
Well,
patient?
you got to ask Jerome Powell on that. My expectation is no. What's really interesting is if you Google Fred, this is St. Louis Federal Reserve data, and you look at effective federal funds rate. If you look in the late 90s, believe it or not, the Fed barely cut interest rates until like 1999. So it's very interesting is they stopped hiking rates and they cut them a little, and then they did nothing until 99 when they basically started cutting them. And so I think actually everything I said about the economy, I continue to believe that the American economy is far stronger than people believe, and I think it will surprise to the upside. And I think that interest rates will probably not go as low as a lot of people hope, but that will not be necessarily a bad thing. I do think that I don't think they're going to go up a lot. I don't think they're going to go up, but I do think that people are massively underestimating what this economy is capable of doing. When you consider that Jerome Powell, basically took it outside and beat it senseless with interest rate hikes, and most people, if you told them 18 months ago that we'd be growing at over 2% and still over 100,000 job growth on a monthly basis and claims under 250 after the kind of hikes that we saw, I think it's fair to say nobody's model expected anything of this kind of strength. So basically, what happens now when they cut rates? I mean, to think this economy is going to accelerate, and so I think it's going to be tricky to really expect long rates to go, 2.5 doesn't seem likely to me. 3.25, that could be something, but under 4, yeah. I think, but my point essentially is I think that the real movement in rates is more or less over, and I think people moving on at this point to the next thing.
To Jerome Powell really beating down the market, yes. I mean that I at some point when I sort of have some free time, I want to reflect on just how brutal 2022 to late 2023 was for not necessarily the large caps, but just for a breadth of thousands of equities. So, and then your aspect of the strength of the economy, yes, that is, well, I think that's what's great about this show. You always have a nice contrarian take that people should consider in their thesis or the way they're looking, right? Never be so convicted on one side. And the market showing strength in a GDP, GDP growing, that would surprise quite a few people, I'll say. But you have a good point because now we're entering the holiday season, which is by far the highest spending time of the year for consumers. Like it's really hard for GDP to shrink during the holiday season unless there's something quite bigger than markets is going on. But I see you pulled up the Euro JPY. How did this come to mind?
Well, the fact is that the yen is not screaming higher. I want to just kind of point out we talked about the Aussie and the euro. These are the things to watch. And despite rate cuts, we're not having the nightmare scenario of the yen, you know, exploding higher and all the other currencies collapsing against it. So I wanted to just mention that first of all because it kind of shows that in a in a bull market, the bad things just that you think are going to happen don't happen. But the other thing is with the strength of the American economy and things like that. I wanted to just kind of very quickly touch on that. I just had on my list I wanted to mention because this was an intermarket signal that told us that there was not going to be extended kind of selling overall in the market. So I wanted to just highlight that one. Steph, you asked me about housing before, and I just want to throw and mention it. If you look at the ITB, the home builder ETF, this actually had some bad news recently. And I think what's very interesting about these guys is that these guys have actually been they've been giving offers to sell houses. And I think what's going to happen is as interest rates move down and people start listing existing homes, these home builders that have been in a market all by themselves are going to suddenly start facing people wanting to move who have made a lot of money on their houses. Say you bought a house 10 years ago and now it's up 100% maybe in that time. If you list it for 500 and then you can't sell it, not a big deal to move it maybe down by to 45, 450 or something. Well, that's really bad news for the home builder. And I think right now these guys are going to face a pressure of people moving as interest rates move down and the market unfreezes. These guys are going to suddenly face an environment where they're competing against a lot more. So it's going to be interesting is they're going to be building more houses and their profit margins are already showing evidence of breaking down. We saw that in DR Horton. We saw it in Lennar. And I think that's interesting. I want to just kind of point that out, but it also kind of shows what am I saying? I'm saying home prices can actually kind of come down here. And again, that fits into inflation. So as much as it might sound strange, lower interest rates can actually depress home prices. And I think that's what we're going to see because what it's going to do is it's going to make the market go back to normal and unfreeze it. And so that's another kicker of dovishness that comes along. The energy thing and then the home builder thing. And I would say we don't yet know about this clearly, but the AI thing that is going to boost productivity. These productivity numbers, the one we saw last quarter, it was so high. And so what happens when the AI really starts kicking in? Walmart already said AI was really boosting their productivity. So we're going to see things in here that are going to also result in lower inflation. So all these things are kind of coming together to me in a way. I want to just kind of emphasize that it's not exactly charting, but the charts are telling us things here.
David, there is so much valuable insight into what you just said. I almost want to save it for another show, but if you don't mind, I just want to try to bring some additional color to that because it's just needs to be said again. Your productivity number comment is super interesting, and to think that we're only in the very early innings of AI, right? People are able to write fast, brainstorm fast, get edits fast, peer review fast, emails faster, everything's being written better, less spelling mistakes, like creating images faster. And this is inning one. We've barely had this technology for a year, so that productivity number, I mean, people, it's hard not to think big about that. But this leads me now to the real aspect, which is fascinating. That a product like AI can lead to deflation or slowing inflation.
Absolutely. Yeah, in the 19th century had massive economic growth and deflation. Why? Because people were using trains and all kinds of things, new technology, modern technology, manufacturing, all that stuff. As it came on, the economy got massively more productive and you had steady deflation in the 19th century, even with the economy growing like 5, 8% a year. So it can happen. And so I just had to mention that. But I have to just mention silver. I mean, I think we just have to realize silver has, maybe some potential here. These are levels going back like, I don't know, 15 years, something like that. the 12 years, in silver, gold hitting highs, silver not. I mean, it's a crazy asset, but I think we have to kind of keep it on our radar. PCE in the morning, that might be something as well. I mean, it hasn't, I mean, it's kind of, you can say breaking out. Maybe it has not broken out. We did a TradingView ID on this when it was about 5, 6% lower, and it has kind of continued higher. There is this trend line on a different chart. I had the trend line of, you can see how it's kind of broken that trend line. But anyway, um, I had to mention that one. And then
Of
just
course.
one little, all right, so I just had to really quickly mention Pan American Silver. This one here on a daily chart is also just, I'm just looking at it as this kind of this level here as, another one of these names has been just kind of struggling. And I was thinking that this is maybe a potential trading view idea, but again, this is also something where if silver does break out and start to run, a name like this has been kind of just dead. And sometimes, I think people haven't really paid attention, but if silver does start to run, it can kind of, a lot of these silver miners are way below where they were 10, 15 years ago. Um, another chart I want to very quickly mention was crude oil, because I do think that this is something that we have to be kind of like watching as, I have this old line on it, but all right, wait a second. How did I do this? I did it. I marked this up before to show one of my colleagues. So if you look back to 2014, you can see crude had kind of held a level and it just broke. And now I think we need to also realize, you know, I just wonder if it's the same situation. And what's interesting is that happened in well, I guess, September, October. So we're in a similar sort of series. Yeah, I'm not an expert in crude. I'm not gonna try and, say anything about the seasonality of it. But to me, what's interesting is you see it basically break a level and crumble as production increased. And then look at this right here. So I'm just watching crude because I think that's something here that, I kind of think that a long-term trend is that crude oil is going lower. The United States is producing more, other countries are producing more, and China, and overall, as time goes on, we are consuming less relative to GDP as a global economy. And with AI and everything else, it's going to mean fewer trucks driving because there'll be smarter routing. There's going to be all that stuff. So I just think you look at it right now. This to me is another chart to watch, because when energy goes down, it can give some really great opportunities for trend following. We did this idea on Chevron recently. Chevron basically, I mean, look at this. It just got slaughtered. It, went up, made that the lower weekly high. We did a trading view idea on it. We had talked about Halliburton as well, that basically, um, this one, I mean, this is like about as perfect of a bear flag as you're ever going to see.
Can you
Schlumberger was very, all
you
right,
should almost
sorry.
draw that? Oh, look at that bear flag too. Oh
Yeah.
yeah, just show people who don't see the flag. Yeah,
And Schlumberger had a very similar pattern. Right here. You look at how when it got below and stayed below, it just accelerated down to the downside. So these things are out there. I want to point that out, that I think that this level, this longer term level in crude, that I just showed. I mean, I'm not going to claim I know exactly where it is. That's the one thing. I'm not an expert in energy. And when you look at the futures, there's a lot of other things out there. But I want to point people in this direction. I mean, I look at the stocks. We do mostly our ideas on the stocks. The last one we did was Chevron. So we wait for it to be kind of obvious to have a signal based on, well, that's Clorox, CVX. We wait for the signal. The signal was stochastics went overbought. We actually had our idea right here. Chevron might be overbought. So anyway, actually, I want to mention Texas Instruments. We did this one. What's interesting about Texas Instruments was that it really was at a very tight level, also near an all-time high from like 2 years ago. So it's kind of interesting. I think TXN, that might also be a name that it's kind of been dead. It's been just moribund. It's done nothing. It's been sitting and drifting. And here it is. You might want to check out this idea.
so I have so much to say there, and I know for our viewers, we like to keep our show to an hour, so we got a few minutes here. So let me see if I can get to my questions quick, so we can keep this rolling, because I do want to talk about silver and gold as well. Go back to those charts, but quickly to the oil aspect. Wow, that oil chart you had up, if it breaks in a similar way, I mean, we could theoretically see $40 a barrel again, which is, I mean, hey, I've been driving a little bit more now that I have two kids, and I have to say that would be a beautiful thing. And I think a lot of consumers would save a few bucks if that happens. That's interesting. And to your macro sort of tailwinds, like pushing that along, I agree. Electric cars, AI, less and less oil per GDP. I mean, the forces are there. I need to mark this chart down. I had forgotten to look at this chart of oil. And then those oil stocks that you showed, it's so interesting how markets will follow the same pattern. Like they're all different stocks, but they all are forming that flag pattern, dropped. They retraced, now they're back on the way down. It's just so interesting. Somebody must have some like program that can just target the sectors so quickly. If you have anything to add to that, I do want to though ask you about silver and specifically why not gold? Why not chart gold?
Well, the thing about gold is I think we all know it's in an uptrend, and I'm not someone who tries to predict things like pullbacks or anything like that. To me, it's in a clear uptrend, and if anything, it's now simply a question of do we see that extend? I mean, gold here. I'm not sure how high it goes. I'm not. I'll tell you, one of my strengths is not projecting. I'm not as good at projecting price levels. I kind of look for things to move until I get a signal that they're not moving anymore, and I don't see anything right now in gold that does that. So it was
Interesting.
interesting to see how it held the 50% and had, I think we looked at this at different points in time.
Yeah, we've charted gold a few times, and I'll say for me, since we've charted gold, I can remember I've gotten this chart very wrong because I remember when we were speaking many months ago, if you zoomed out, there was a triple top forming.
Yeah.
And I was of the impression of just classical technical analysis. This is like the largest triple top I've ever seen. It was going back multiple years, and yeah, it's just it actually tested that triple top, and now look at it, it's taken off. So hey, you do get them. I get them wrong every once in a while. I think that's part of it. But the silver chart then is interesting, and it's one of those metals that just sort of I can't believe it's still at $32. Like while gold is up so much more than silver, it's hard to fathom. I don't know what's going on there. It's well worth looking into.
Yep. Well, I'm just looking at this kind of see if we get the breakout in it. But this is one I think to keep on our list for the next few weeks. So
Great. Okay, well, we've got a few minutes left here, so I think we should then wrap up the show just to make sure we get the proper, final commentary here. And the first thing I want to say is it's critical that everyone who watches the show knows that once again, David is the man behind the TradeStation account on TradingView. They have got over 50,000 followers there. You can see all of the ideas that he's publishing right here on the screen. You're getting a deep look and a real-time look at his insights, his charts, his levels, all of the descriptions that he's writing about the chart. So if you're someone looking to see what's happening in markets, new ideas, I mean, you're getting it directly from the source. I personally can't think of anything cooler than that, right? Like this is a two-way conversation. You can leave comments, boost his ideas. And also, I would add too that David and I do this show each month. So you can watch the ideas get published, then come join us, and you're getting like a pretty fantastic, market research recap every 30 days or so. So with that being said, I want to say thank you, David. This was a great show. I need to think about some of the things we talked about a little more, especially the AI productivity boost, pushing down inflation, which could in turn lead to rate cuts. That's a big one. So if you have any final comments, it was a great show and thank you.
great to see you, Steph. Take care.
Cheers. Thank you. I'll see you.